Ladies and gentlemen, please welcome Dave Marchik, Dean of the Cogood School of Business.
Thanks for being here. We even have a British accented voice of God, so we sound a little smarter, which is great. Thanks for the turnout. There's a short turnaround and it's a packed room. Welcome to this important program with Fed Governor Michael Barr. I'd like to thank our co-sponsors, the School of Public Affairs and the Washington College of Law. And also thank you to Alan and Amy Meltzer. They sponsor a speaker series, which enables us to do events like this and turn them around quickly. So thanks, Alan, for being here, Max, and for allowing us to host events like this at American University. Michael Barr took office as a member of the Board of the Governors of the Federal Reserve System on July 19th, 2022. He served as vice chairman for supervision of the board for 3 years. Prior to his appointment as a member of the Federal Reserve, he had a really important job. He was a dean. In this case, he was the dean of the Gerald R. Ford School of Public Policy, and he was also a professor of law at the University of Michigan School of Law. His bio is both impressive and intimidating. He attended Yale Law School, was a Rhodes Scholar, was a clerk on the Supreme Court. He's worked in senior roles in the White House, the Department of Treasury, the State Department, and now the Fed. And his standard for excellence that you've seen across his career is matched only by two things: his commitment to public service and his impact. And I was thinking about this last night. Maybe with the exception of James A. Baker, who served in multiple administrations, very few people have had an impact like Governor Barr and involved in all of the major crises that the United States has faced in the last 30 years. So Governor Barr has been in the middle of the resolution and response to major financial crises. He started his career at the Treasury Department during the Latin American and Asian financial crises in the late 90s. He was at the Treasury again and the White House to fight the housing, mortgage, and financial crisis, which occurred in 2007 to 2009. And more recently, he was vice chair at the time when the Silicon Valley bank crisis occurred and there was a run on various regional banks. Each of these represented scary moments for our economy and had real negative impacts on households and livelihoods of Americans. They lost jobs, earnings, savings, and in many cases, dignity. I worked at a financial institution during the financial crisis of 2008, and I showed up scared about my job, my savings, and my future every day. They impact real lives. Governor Barr is also widely known as one of the key architects of the Dodd-Frank Act, which Congress passed in the wake of that financial crisis. For students in the audience, banking crises are scary. You're probably too young to experience one, but we all have confidence that our savings and our money in banks are going to be safe until they're not. And that's when it's scary. So that's why supervision and regulation is so important to the safety and soundness of our financial system. Governor Barr will speak today on how thoughtful supervision can help ensure a sound financial system that enjoys the confidence for all Americans. So Governor Barr, thanks for being here. He's going to speak. We're going to take a few questions and then open up to the audience. Thanks very much.
Thanks, Dave, for that very warm and kind introduction. It's a pleasure to be back here at American University with all of you. American University was kind enough to award me an honorary degree recently, and so I'm thrilled to be back in your company. Thank you to the Meltzer family for organizing these series of events, which this is part. And thanks to all of you in the audience here in person and online who have come to hear a very technical topic. But as Dave explained, and as I'll say more in detail, supervision really matters to the lives of individual Americans. I'm pleased to be here to discuss a core part of the Federal Reserve's mission, banking supervision. Much of what the Fed does to conduct monetary policy, promote a stable financial system, provide a safe and efficient payment system, and support consumers and community development depends on a healthy banking system. Lending fuels entrepreneurship, helps families buy homes, and enables communities to thrive, all critical aspects of a healthy economy. Ensuring banks operate in a safe and sound manner is essential because the banking system sits at the center of the economy. That is why banks' risk-taking must always be guided by clear guardrails, underpinned by effective banking supervision. We need these guardrails because experience shows that market discipline alone does not prevent excessive risk-taking by banks. As I've noted before, time and again, periods of relative financial calm have led to efforts to weaken regulation and supervision. This has often had dire consequences, as we saw prominently during the global financial crisis. In the midst of that crisis, I saw firsthand in my own community in Michigan the way in which weak regulation and supervision could mean foreclosed homes, shuttered businesses, and lost jobs. According to the Federal Reserve Bank of Chicago, Michigan's unemployment rate was 14.9% in 2009, meaning that 1 in 7 workers were out of jobs. Nationwide, the consequences were immense. Nearly 9 million jobs lost, 8 million foreclosed upon, and 17 trillion losses in household wealth. We are now, I believe, at a moment of inflection in the regulatory and supervisory approaches that help to keep banks healthy. There are growing pressures to weaken supervision, to scale back examiner coverage, to dilute rating systems, and to redefine unsafe and unsound practices in ways that will make it harder for examiners to act before it is too late to prevent a buildup of excessive risk. These pressures present real dangers to the American people. Let me begin with the mission of bank supervision, which is to promote a safe, sound, and efficient banking system that supports a strong economy. Our banking system relies on trust. That trust is earned when banks behave responsibly and when supervisors effectively perform their statutory duties. These duties include verifying that banks are operating soundly and identifying and addressing weaknesses before they threaten the solvency of particular banks and possibly spread throughout the financial system. Supervision also ensures compliance with laws and regulations that safeguard the integrity of the banking system. This reduces the risk of misconduct or malfeasance, including real-world consequences of fraud, consumer abuse, cyber attacks, money laundering, and terrorist financing. Trust in the banking system relies on strong supervision. Supervision delivers clear benefits, not only for individual banks, but also for the stability of the financial system as a whole. Enforcement actions are associated with lower systemic risk, and research shows that banks subject to more oversight are safer and just as profitable as their peers. While supervision does impose costs, it is most effective when calibrated to the risks each institution poses. More closely supervised banks tend to experience steadier income and fewer loan losses, making them more resilient in times of stress, when contagion risks are greatest. Supervision is critical to the Federal Reserve mission to promote the stability of the financial system and contain systemic risk. A macroprudential perspective, where we look across the entire banking system for correlated risks, complements traditional microprudential oversight, where we examine individual banks. This is done by focusing on risks that threaten financial stability and the banking system's core function: credit, payments, and intermediation. Our economy depends on a strong and stable financial system, which makes banking supervision essential for every household and business. Effective supervision begins with appropriate regulation as a foundation. Regulation provides the rules of the road that establish minimum capital levels, liquidity requirements, and define permissible activities. But regulation alone is not enough. Supervision is necessary to ensure banks stay on the road and comply with the rules, especially as conditions shift and new risks emerge. Effective supervision depends on its human capital. The knowledge necessary to be an effective examiner comes from both formal training and through an accumulation of on-the-ground practical experiences. Supervisory staff carry responsibility for risk identification and analysis and execution of examination to assess whether a firm truly understands its risks, whether its governance and controls are effective, and whether its capital and liquidity are sufficient for its business model. Institutional knowledge and experience-based judgment are critical for supervisors' ability to manage these responsibilities. They take time to develop and cannot be easily replicated. Effective supervision also requires moving with the speed, force, and agility appropriate to the risks posed. This requires institutional commitment to act swiftly as risks emerge, using supervisory tools decisively, and adapting to shifts in markets or the economy. Beyond these foundations, effective supervision is based on numerous other factors. Today, I will outline a few key components of strong, effective supervision that are at risk today of being seriously weakened. First, a credible rating environment. A credible rating system incentivizes firms to promptly remediate weaknesses by translating supervisory assessments into objective outcomes that matter for management and boards of directors. It ensures consistency across institutions, supports transparency in how risks are evaluated, and anchors supervisory discipline. Crucially, a credible rating system looks beyond immediate financial metrics to the quality of a firm's governance, its internal controls, and its risk management practices. Weak management rarely shows up first as a capital or liquidity problem. Rather, it becomes evident through inconsistent processes, inadequate escalation of supervisory concern, unclear lines of accountability, and organizational blind spots that over time allow risks to accumulate. These weaknesses can prevent management from seeing and effectively acting on emerging risks. A rating system that captures only past actions that have resulted in observable financial harm is inherently backward-looking. It will miss the risks of what may come. Unfortunately, the framework for supervisory ratings is currently being modified in ways that diminish its strength and credibility. For example, earlier this month, the Federal Reserve Board issued a final rule making changes to the large financial institution rating system. Poor performance is being de-emphasized, which is tantamount to grade inflation, a problem this academic audience likely understands. As I noted in my dissent at the time, I believe these changes reduce incentives for large banks to fix serious management problems. They will also allow firms with significant governance weaknesses to expand or acquire other enterprises, raising the chance and cost of future failure. Changes to the large financial institution rating system also reduce supervisory attention on compliance matters for the largest banks. As such, bank holding companies could have, for example, seriously deficient consumer compliance programs, but still be considered well managed. Further, the revisions remove the presumption that large firms with significant deficiencies must face an enforcement action, a move that could significantly weaken accountability for poor practices. And in taking this action, the board ignored a more moderate reform option that would have established a composite rating for large bank holding companies. In addition, I understand that efforts are currently underway to modify the CAMELS rating system, the interagency framework used by supervisors to assess banks' overall condition. Some have proposed changes that would effectively diminish the weight assigned to the management component. I believe that such a move would be misguided and short-sighted. The management rating is not simply one item among 6. It is the element that ties the others together. It measures the quality of governance, risk identification, internal controls, and the institution's ability to respond to emerging threats. Strong management can compensate for unexpected stress, but weak management can magnify even modest vulnerabilities. De-emphasizing the rating system's focus on management could lead to significant increases in risk, even in institutions that look good on paper. Furthermore, in October, the FDIC and the OCC proposed rules that would limit the issuance of enforcement action for unsafe and unsound practices. This would have the effect of making it harder for supervisors to issue an enforcement action and compel a bank to fix its flaws. This effectively ties examiners' hands. The proposed rule would also limit the issuance of matters requiring attention, or MRAs, which are supervisory findings used to prompt a bank to act quickly to fix problems before they become enforcement actions. The new standards for issuing enforcement actions and MRAs would center on a narrow definition of material financial risk and exclude material non-financial risks except in limited circumstances, such as violations of law. To put this into context, under the standard established by this proposed rule, a bank with woefully deficient controls to prevent money laundering or discrimination would not necessarily receive an MRA requiring the bank to correct the situation unless the bank had actually violated the law, where supervisors were able to identify a material financial harm that had already occurred due to the lapse in controls, or that could be shown to be likely to cause such harm. Waiting to act until the bank, its customers, or potentially the financial system have been harmed is not a responsible approach to risk management or supervision. Bottom line, under this proposal, examiners will issue fewer MRAs, even where financial and operational risks have been identified. This will also lead the agencies to issue fewer enforcement actions. And I fear that the Fed may head down a similar or even worse path, further tying supervisors' hands. I'm also concerned about an initiative that will allow the banks themselves to decide whether a supervisory finding or a requirement imposed by an enforcement action should be lifted. Under this approach, if a bank had a satisfactorily rated internal audit function, that internal audit function would have the ability to decide if the bank had appropriately remediated a deficiency identified in a supervisory finding or enforcement action. A bank's internal audit function would essentially displace validation by Federal Reserve examiners. Examiners would not independently determine whether the terms of the supervisory findings or enforcement action provisions had been met, or whether the bank's changes were sustainable. A similar approach was tried at the Federal Housing Finance Agency, where the internal audit function of Fannie Mae and Freddie Mac was permitted to validate remediation of MRAs, and FHA's supervisory division sometimes accepted that validation in closure determination without independent validation. In 2018, FHFA's Inspector General found this problematic and warned that allowing such discretion, quote, without a predicate supervisory conclusion, creates the risk that assessments will be impaired, end quote. This is a bad idea for bank prudential supervision. And just to be clear, it will not be implemented in the consumer compliance function, over which I have responsibility. A second component of effective supervision is that it must be forward-looking. The purpose of supervision is to prevent risks from becoming problematic in ways that harm banks and the public. By anticipating vulnerabilities and prompting early action, supervisors use tools such as stress testing and scenario analysis to prevent problems from escalating. In contrast, backward-looking supervision often detects weaknesses only after they become serious problems. Forward-looking approaches, grounded in judgment and horizontal comparison, are more effective in promoting the safety and soundness of individual banks and safeguarding financial stability. In short, supervision needs to see and point out how weak risk management can lead a bank to be vulnerable to unanticipated shocks. Stress tests illustrate this principle clearly. They're supposed to provide a rigorous way to assess resilience under severe but plausible conditions that may occur in the future. Supervisory stress tests are structured exercises conducted by supervisors to evaluate how a bank's capital and earnings would perform under adverse macroeconomic conditions, such as a sharp rise in unemployment, a collapse in asset prices, or severe market disruption. They are designed to test the soundness of a bank's balance sheet and to ensure that it could continue to operate and support the economy even in times of stress. These tests help to uncover vulnerabilities at individual banks and across the financial system. In October, the Federal Reserve proposed several changes to our heretofore successful stress testing program. I noted then that the proposed changes risk turning the stress test into a rigid exercise that offers false confidence by producing overly optimistic results driven by less conservative modeling and opportunities for banks to game the process. The proposed changes would weaken capital requirements and erode incentives for strong, independent risk management. Weaker stress tests means worse supervision. Another valuable forward-looking tool that has been criticized lately is the use of horizontal reviews, supervisory examinations focused on a specific topic across multiple banks simultaneously. This technique allows supervisors to spot emerging risks, helping supervisory frameworks remain proactive rather than reactive. Because financial risks develop and change at a faster pace than regulation, horizontal reviews are valuable to compare practices and outcomes across banks, identifying patterns of systemic or interfirm amplification that might otherwise go undetected. Just as importantly, horizontal reviews promote consistency and fairness in supervisory judgment. They're not meant to impose rigid benchmarks or uniform expectations, but rather to shed light on emerging vulnerabilities, highlight sound practices, and ensure that judgments are grounded in comparable evidence. Severely limiting their use would constrain supervisory insight and weaken the ability of supervisors to address emerging problems. A third key component of effective supervision under challenge today is skilled supervisory staff. The strength of a supervisory system depends not only on its policies and tools, but also on the expertise, capacity, and judgment of the people who implement them. Adequate staffing, measured both by headcount and experience, ensures that supervisors can conduct thorough examinations, identify emerging risks early, and respond swiftly to signs of instability. It also supports the institutional memory and continuity needed to address complex financial institutions over time. Having sufficient and experienced staff is crucial. Staff at both the Federal Reserve Board and reserve banks play distinct but complementary roles in safeguarding the financial system. Board staff in Washington, D.C. focus on risk identification, oversight, consistent policy, horizontal reviews, and coordination across the entire banking system. Most board supervisory staff who focus on day-to-day supervision of banks work on banks with assets exceeding $10 billion, rather than community banks. Reserve bank examiners conduct most day-to-day supervision of individual banks and holding companies. Together, these efforts form an integrated supervisory framework. Recently announced plans to reduce staffing in the board's supervision and regulation division by 30% by the end of 2026 will impair supervisors' ability to act with the speed, force, and agility appropriate to the risks facing individual banks and the financial system. Such a drastically reduced staff will slow response time for the public and the banks themselves, limit supervisory finding and enforcement action, and erode supervisors' ability to be forward-looking. Losing experienced supervisory staff with institutional knowledge also means the system will have diminished capacity to manage crises when they arise. Among other things, the financial crisis showed that the Fed bank supervision had failed to keep up with the growth in the size and complexity of the banking system, and it took nearly a decade afterward to build up this capacity. Now it is being gutted practically overnight. The impact of these staffing cuts is compounded by reductions at other supervisory agencies. Deep reductions in force are underway at the FDIC, the OCC, and the Consumer Financial Protection Bureau, with the CFPB recently announcing that it would not seek any funding for the foreseeable future. It is difficult to argue, as some have, that the Federal Reserve can rely solely on the work of other agencies in its holding company evaluation, when those other agencies are also experiencing significant contraction. Let me close by emphasizing that I support the healthy evolution of banking supervision. It is both natural and appropriate to regularly assess supervisory approaches and tools over time. After periods of crisis, regulators logically strengthen oversight to prevent a recurrence. After periods of relative stability, there is often pressure to lower the guardrails put in place. Adjustments can be constructive, but they must be made with foresight and care to preserve the hard-won resilience of the financial system. Today, I have outlined several essential components of robust banking supervision that I believe are being altered without sufficient appreciation for the consequences of these actions. Weakening any one of these elements diminishes supervisory effectiveness. Taken together, the cumulative impact could be profoundly damaging to banks and destabilizing to the financial system. History reminds us that we've seen this pattern before, including in the financial crisis. Periods of weakened supervision have often preceded episodes of financial excess and instability. The erosion of supervisory resources, the diminished focus on governance and controls, the weakening of forward-looking tools, and the constraints placed on supervisory action all undermine supervisors' ability to adequately protect against excessive risk-taking. When coupled with broader deregulatory momentum, these trends create a dangerous environment for both institutions and the economy at large. The vulnerabilities that weaker supervision and regulation create may not be visible in the short term. They rarely are. But experience tells us that the bill always comes due. The only question is when and how high the cost will be. Thank you very much.
So I'm going to ask 3 questions, and then we'll open it up to anybody. So my first question is about what you just said. So thank you for, that was an important speech. Thank you for making it at American University. And Fed officials are historically a little opaque and careful in what they say. We actually have professors here, Robin Lumsdain, who they use AI to interpret what Fed officials are actually saying. Okay, so, but what I heard was a warning, some very strong and maybe unusual language for a Fed official, inflection point, tying examiners' hands, irresponsible, gutted, and dangerous. And then you ended with kind of a warning for the public. So I've been in the government with you when we've had financial. Where are we on that continuum of risk that something could actually happen that affects average Americans that are not trying to interpret Fed officials' statements every day?
Well, thanks, Dave, for the question. And you're right, I tried to be as clear and direct as I could in this speech because I am deeply concerned about the changes that are taking place. Let me say, I believe that today the banking system is sound, is strong, is organized in a way that people can have faith and trust in. What I'm sounding an alarm about is the future. And as I noted in my formal remarks, the kinds of changes that are taking place today, we won't see for a while. You might not ever see publicly, but what they're doing is undermining our ability to hold the banking system accountable and to make sure it stays safe in the future. So I'm not saying anything about the safety of the system today. I believe the system is sound. I'm worried that over time, it will undermine that safety in the system and undermine the trust that Americans have in that system. And that's a very large risk that I don't think we should take.
Let me shift to another aspect of your job, which is, you have supervisory, but then you also have macro. So you have an important meeting coming up in December. Interest rates have been the hot topic. Where do you see the economy at this moment, and what does that mean for your views of what you will do and what the Fed will do on interest rates in December?
Well, let me first say, especially when I speak about monetary policy, really everything, but especially monetary policy, I'm only representing my own views and not speaking for my colleagues on the Federal Open Market Committee or at the Federal Reserve Board. So in terms of how the economy is doing, let me say we've made enormous progress on inflation over the last several years. We had very, very high inflation when I joined the board in 2022. And inflation has come down significantly over those 3 years. Unfortunately, it started to climb back up. So we've been making relatively steady progress until the spring of this year, and then we stopped making that progress. And a good hunk of that is we're seeing the effects of tariffs sort of work their way through the economy. So goods prices have been going up and are continuing to go up. We are making progress on housing services inflation. That's coming down. Services inflation excluding housing, we had been making a lot of progress, but that may be in a state where it's stalled out. And given that we still have a ways to go to hit our 2% target, we're running inflation close to 3% right now, and we want it to be 2%. We're committed to getting inflation down to 2%. I'm concerned that we haven't yet met that objective. There's more work to do. And at the same time, we're seeing a labor market that has also softened over the course of the last year. So we're seeing employment numbers that are probably a little bit below the break-even rate needed for the number of people in the labor force. The labor force has declined a lot because we had a lot less immigration this year, and labor force participation rates have also come down a bit. But we do see a softer labor market. And so what we're trying to do is balance these two concerns we have. Congress gave us what's called a dual mandate at the Federal Reserve. We're supposed to pursue maximum employment and price stability. And right now, those goals are in tension. We are at a level of unemployment that is quite low historically. And that's very positive. But with these very low payroll numbers, we have to worry about the state of the labor market. That's, I think, why you saw us cut over the last year and a half. We've cut interest rates by about 150 basis points, recognizing where we are in that process. We're now at this judgment point where we have to decide what is the appropriate thing next. I'll be looking carefully at the data that's coming in between now and the December meeting. We should have another report on Friday. We'll have some additional data, perhaps beyond that before the December meeting. But we've had a period over the last month and a half where we haven't had official U.S. federal data. And that matters not only for the official unemployment rate, but also very importantly for price data, which is hard to collect through only private sector sources. So we haven't had all the information we'd normally have over the last month and a half. And that also, I think, feeds into our thinking about this December meeting and beyond. So I guess what I would say is I haven't made any decision about December, but I think we need to be quite cautious given that inflation has remained elevated over this last year.
Okay. My last question is about AI. You just gave a very significant speech in Singapore on AI. We're very focused on equipping our students with AI tools so they can be competitive in this very challenging labor force. We've seen, I think, more layoffs this year than any year since the financial crisis through October. So what is your outlook for AI's impact on the economy, both positive and negative?
Well, I do think artificial intelligence is going to be one of the most important stories people write about our economy at this stage and for several years into the future. I believe artificial intelligence is likely to have a significant impact on the economy, on productivity, on scientific discovery in the coming years. So I think it's going to be quite profound. I think you're right to get your students focused on what that might mean for their role in the labor market and also their role in society more broadly. Artificial intelligence today is probably playing some role, but a pretty small role in the labor market picture we're seeing. We do see some evidence, research suggests some evidence that for particular sectors of the economy that are highly exposed to artificial intelligence activity, that young workers, in particular, new entrants to the labor market, are probably being hired at a lower rate than you would otherwise expect. But we're not seeing more broadly AI's effect yet on the economy, on the labor market. I do expect that we're going to see further effects in the future. How that shakes out in terms of labor market opportunities, I think, is unclear. Artificial intelligence is likely to have different effects. One effect it'll have is it'll substitute for certain jobs. So some jobs that are easily replicated by artificial intelligence will diminish. So things like working in a call center will likely go down. Some basic things like answering questions about human resources in a benefits organization. So you can imagine some jobs will just, we'll see a reduction in those jobs. That's sort of AI substituting for human beings. There's a second category of thing that will also be really, really important is that artificial intelligence will complement human labor and make humans massively more productive. And that's a very good thing because higher productivity means higher wages. And if you're more productive, you'll be able to we'll be able to grow the economy in a way that benefits everybody. And then the third thing that will likely happen with AI that's happened with other technologies that have been important transformative technologies is that new jobs will be created that we've never heard of. And those new jobs, people will look back on the jobs that we do today and say, why'd you do those jobs? These new jobs we have are so much cooler and more interesting and more productive. So those three effects are going to happen to the economy. I'm pretty bullish that if we can get through a transition period that may be a little bumpy for people, that overall the effect is likely to be quite profoundly positive for our society, for, as I mentioned, discovery, the ability to cure diseases that we think are incurable today, the ability to find new technologies that might help us deal with climate change. I think this technology is likely to be profoundly positive. But I do think in this maybe transition period over the next several years, it could be kind of bumpy, depending on how fast AI is integrated into the economy.
Well, that's why we're focused on equipping our students with all the tools so they can be more competitive. So thank you again for that speech. So who wants to ask the first question? Just introduce yourself, what year you are, and then ask your question.
Hello, my name is Joshua, and I'm a first-year political science student here. And let me just start off with the million-dollar question. What is the Fed doing or should do to preserve its independence, maintain the integrity of the regulatory mechanisms you talked about, and focus on its dual mandate goals in the face of extreme political pressure from the executive to deviate from those goals?
Good freshman question.
Yeah.
That's better than I could have done. Yeah.
It's terrific. And first of all, let me just say it's great to see so many students in the audience and to have a student question be the first question from the audience. I really appreciate that. I do think that the independence of the Federal Reserve is absolutely essential. Research on central banks in the United States and around the world has shown that independent central banks are best able to deliver benefits for the people they serve. So we're best able to serve the American people in making sure that we can pursue our goals of maximum employment and price stability if we're independent. We can best meet our goals of ensuring that there's a safe and sound banking system by being independent. We can best preserve the backbone of the payment system by acting only independently. And the way that we focus on doing that is by actually acting independently, by not letting any political force drive our decision making. And I can say when we're sitting around the table in our discussions about interest rate policy, people are focused very much on the substance. They're trying to understand the data as best we can as it comes in, what that data means for our understanding of the economy, how that data affects our individual forecasts of what's going to happen in the economy, and then the balance of risks we face. I talked about the risk to the employment mandate and the risk to the inflation mandate. We just focus on doing our work. And when I talk to staff at the Federal Reserve System, when they ask me how do I think about how they should react to the kind of swirl around us, I say steady as she goes. Get up every day and you do the work, and that's the work the American people is relying on, is counting on us for, and so that's what we have to do.
Okay. We have another student question over there, and then Professor Tamura.
Thank you for taking my question, Mr. Barr. My name is Anmol Kimere. I am a freshman majoring at finance here at Kogod. My question for you is, how big of a threat is de-dollarization and the adoption of different reserve currencies across the world from different economic unions like BRIC or the Chinese yuan?
So let me say, before I answer your question, I'll give the usual kind of Federal Reserve disclaimer. The dollar policy of the United States is not the province of the Federal Reserve, that's the province of the Treasury Department. So what I'll comment on is just my understanding of what's going on, not policy about the dollar. So the dollar has been the dominant reserve currency at least since World War II. And it remains the dominant reserve currency in the world today. My own personal view, just speaking as an observer of the economy rather than as a Fed official, is that that is unlikely to change significantly in the next 25 years. Why is that? Because there's not really any alternative reserve currency that people can credibly point to replace it. If you look around the world, the kind of trend you see right now is not really de-dollarization. In many cases, it's more dollarization. There are many economies that are moving their economy more towards a dollar-based economy. If you look at newfangled kinds of private money, stable coins that are being created around the world, those are overwhelmingly denominated in United States dollars. So countries that are moving to use stable coins are dollarizing more, not less. So that's, again, not a policy view, but just my view of how I see the facts and the trends.
Professor Tamura? This will not be as good as the freshman questions.
I need Timothy Fura. I am the academic director of Student Money Management Smith degree. You are welcome any Monday or Thursday evening for our meeting. I think you would fit
Just
right
use the mic for the cameras.
I think you would fit right in. My question isn't about the supervisory abilities of the Fed with the commercial banks, with the banking system. My concern is with private credit. I've been taught by Kindleberger and Schiller to always look to some place where other people may not be looking. How much does private credit concern you at this point?
Well, that is good advice from exceptionally wise human beings. So I'm glad you're taking it up. I do think it's important to look at all the corners of the financial system to see where there might be risk. Private credit has grown significantly in the last decade. in the neighborhood a little bit under $2 trillion in value today. And there are aspects of it that historically you would say are safer than other aspects of the financial system. So I'll highlight those first, and then I'll highlight the risks. So what are the safer aspects? So generally speaking, private credit until quite recently has been funded by long-term investors and not retail investors, and the funding has been locked up, so not runnable kinds of funding. The funds themselves tend to be not highly leveraged, internal to the fund, and those two things are positive aspects of the private credit system. So what are some of the risks? Well, one of the risks is that private credit is highly opaque. So we don't have as much data on the performance of the loans and within the private credit portfolio. Credit spreads would suggest, which are very tight in private credit right now, suggest that risk is being somewhat underpriced. Private credit has not gone through a cycle where, through a recessionary cycle, so performance has not been tested in that way. So that's another area of risk. The companies themselves that they invest in, I mentioned the funds themselves are not highly leveraged, but the companies tend to be highly leveraged companies with higher debt exposure, which is an area to be concerned about. There are some payment features that are common in private credit loans called PIK, or payment in kind features, that permit an entity to, instead of paying the amount that is due on the loan when it's due, they can skip that payment and capitalize it into the loan term. And that means that we may be missing defaults that have actually happened, not legal defaults, but non-ability to make that payment that are hidden by the PIK terms of the loan. And then more recently, some private credit funds have gotten more retail exposure and have borrowed more in the short-term funding markets. So that creates run risk and retail risk that had not been present until quite recently. That's an area of potential concern. And there's more bank involvement with private credit than there had been until quite recently. So you see more banks lending, providing liquidity to private credit, or sponsoring private credit funds. And that creates some interconnection with the banking system that's worth looking out for. So that's how I see private credit.
Okay, Alan Meltzer, and then Professor Bruno, and then we have another student. And Carl.
First of all, thank you for being here.
Yeah.
As a consumer, as an investor, in retrospect, interest rates staying low so long and then rapidly going up, the real estate market, at least in D.C. and many other places, you see promoters of real estate deals based upon the low interest rates having to put on terrible debt, and now foreclosures all over the place. I guess you did that because of inflation, but in retrospect, do you think maybe we kept it too low for too long and then too quickly up?
Yeah. So it raises a very difficult set of trade-offs. Let me describe a little bit about the inflation and interest rate path, and then comment a little bit about particularly the effect on commercial real estate, where the effect is quite strong that you described. So, this is obviously before my time, but the Federal Reserve, before my time at the Federal Reserve, not before my time. We were just discussing how long we've known each other.
Michael's aged better than I have.
Yeah, sure. There was a very long period of time in the United States after the global financial crisis when inflation was stuck below 2%, and the job growth was too weak. And so the Federal Reserve was keeping interest rates low and also growing the Federal Reserve's balance sheet to try and bring the economy back to full employment. And I think they kind of had to do that. But one consequence of that was when people got used to that very, very low interest rate environment, and some deals that got done in that environment kind of don't pencil out anymore in a higher interest rate environment. We saw significant declines in the value of commercial real estate when interest rates went up, in combination with the pandemic-induced changes in work behavior. So lots of commercial real estate buildings had very high vacancy rates because in response to the pandemic, companies started offering work from home. And some of that has come back, but basic patterns of work from home are going to stay different from the way they were, pre-pandemic. So vacancy rates are something to watch out for, and higher interest rates are something to watch out for. That commercial real estate exposure, also created some risk in the banking system that needed to be effectively managed. It's true that the rapid increase in interest rates made that more acute, made it more difficult for banks to manage that risk. I would say that level of risk has come down over the last couple of years, and the level of defaults and foreclosures, while elevated, is somewhat lower than I feared several years ago. I know that's a cold comfort, but things are not as bad in that market as they might have been.
Okay. We have a student here, and then Professor Leader. Oh, wait, I'm sorry. I was promised to go to you, and then Professor Lederman, and then we can take a couple more. Oh, and Professor Bruno. I'm sorry. I don't want Valentina to be mad at me, so let's go there.
Well, thank you for your speech and for also inspiring our students to pursue studies in financial markets and institutions. So here is my question. So financial vulnerabilities are the most dramatic and visible during crisis. But arguably, they are the most damaging in boom times when they operate away from the glare of the cameras and the televisions. In fact, the financial crises do not happen out of the blue. What side of the financial system do you see the greatest building up of vulnerabilities now?
So I think you're absolutely right that financial crises don't come out of the blue. They are built over time. Vulnerabilities rise in the system, and they're not especially noticed except by good supervisors in good times. And one of the reasons why it's really important to have strong supervision is so that in good times those risks don't build up in ways that, when a shock hits the system, create a crisis. It's why I gave this speech now. I'm not giving the speech now when we're in the middle of a crisis. I'm giving the speech now when the economy is sound and the financial system is sound, because of the very point that you just made. We need to address and make sure that those vulnerabilities don't grow up in good times, so that when a shock hits the system, it's a problem. So what kinds of vulnerabilities do I see? So we talked a little bit about private credit. I think that is a vulnerability. There are vulnerabilities that have built up in the insurance system that are related to private credit and the entrance of private equity into the insurance sector, where in the life insurance aspects of the life insurance sector, you're seeing more short-term liabilities and more use of opaque private credit and securitized assets with weak ratings. That's not a good combination of things. More liquidity, more maturity transformation, and more credit risk in the insurance sector, I think, is an area to watch out for. In the treasury markets, there's a very large role for hedge funds today, and that provides a really essential liquidity for the market in good times, and it helps make sure that hedge funds can arbitrage away price differences in the market, so we keep cash markets and future markets appropriately linked. So they play really important roles in the treasury market. But it does mean that if stress enters the treasury market, that you could get a rapid unwinding in the hedge fund sector that could be worrisome. Or if you have in the hedge fund sector a shock to, say, the equity holdings of hedge funds, that then spills over into their ability to intermediate in the treasury market, that could also be a risk. So these are some of the kinds of things that I worry about. And lastly, I'll just say, I mentioned in my remarks that this focus, if supervision focuses on material financial risks, what are they not focusing on? One thing they're not focusing on is cyber risk. And cyber risk, as all of you know, is ever present. And unless we have appropriate safeguards in place in the banks and supervisor checking that, cyber risk is always an area to be worried about.
Good question. Okay, student and then Professor Lederman, and then we're going to close unless Sharon tells me we have more time. Okay.
So good morning. My name is Damiano Trovato. I'm a graduate student at the School of International Service. And my question is about personal debt. So personal debt has been increasing. I think it surpassed 18 twice the risk profile of the issuing institutions. And if taking on so much debt can be a risk for the health of the economy as a whole, especially as a large chunk of the population is living paycheck to paycheck. Thank you very much.
So we obviously track at the Federal Reserve household debt and business debt quite carefully. For some segments of the population, personal debt has been increasing, particularly at among low and moderate income individuals. We are seeing some elevated levels of defaults in, say, the subprime auto sector and subprime credit card sector, but they're at levels that are not out of the historical norm. Other parts of the household sector are unusually healthy, and that's in part because there's so much housing wealth for people who have houses, who own houses. Loan-to-value ratios are much more conservative than they were before the financial crisis. Household balance sheets for middle and upper income people are very, very strong. So there are kinds of two things going on in the economy in the US at the same time. There's difficulty among low and moderate income households and some additional credit pressures, and there's sort of additional strength among middle and upper income households at the same time.
Okay, Professor Lederman, last question.
Hi, Michael, you know me. So Governor Barr, I can vouch he has not changed in 35 years since Yale Law School. Going back to vulnerabilities. So on the Financial Times, the front page this morning, I read that the Treasury Secretary is talking to UBS about shifting its headquarters from Switzerland to the US. So when you look at the weakening of the guardrails and vulnerabilities, how concerned should we be that we may be importing some of the biggest issues of the biggest banks in the world into this country, because we're now seen to be a more, how should we say, regulatory soft regime as opposed to other countries? So how worried should we, and is that the tipping point that we might be looking at?
So let me, Carl, let me answer that question without commenting on the particular article or person that you mentioned, but let me just say more generally, I think it's important for us and other countries around the world to have a level playing field in financial regulation and supervision so that there's not a race to the bottom in standards, there's not regulatory competition that would induce people to move their headquarters based on where they can find a weaker link in supervision or capital standards. It's important for us all to have high standards. In the 1980s, the process began through the Basel Committee on Banking Supervision to have standards around the world that were the same in all the major jurisdictions. It's been a wildly successful initiative for many, many decades now to make sure that we don't have a race to bottom in those standards. And I think it's really critical that we maintain those high standards. Right now, the United States has not finished the Basel capital process that started in the wake of the global financial crisis to what's called the Basel III endgame, the last piece of that capital puzzle. I think it's really important that we meet our international obligations, that we implement that standard, and that we don't do things that would make it seem like we're open for business by being the weakest point in the chain. So that's how I would answer, again, without reference to the particular article or person you mentioned.
Well, thank you all for being here. Governor Barr, thank you for giving this important speech. Thank you for coming to AU, but mostly thank you for your service to our country. So thank you very much.
Thank you.
Thank you very much.
Terrific students.
Really smart. Yeah.
Yeah.
All right. Thank you. That concludes our program.